History doesn't repeat itself, but it often rhymes. Mark Twain. Nowhere is that more obvious than in investing, because every generation thinks their bubble is different. In the 1600s, people were taking loans to buy tulips. In 1999, people bought companies with no profits because the website had .com in the name. In 2021, a digital picture of a monkey sold for more than a house in Ohio. And today, half the internet thinks AI stocks will create a utopia. The other half thinks we're one Federal Reserve meeting away from eating canned beans in a bunker. So here's the real question. Where do you actually put your money? Because investing isn't just about buying stocks and chilling. It's a giant ecosystem of asset classes, each with different risks, personalities, and ways to absolutely ruin your sleep schedule. Today, we're breaking down every major investment asset class, from stocks and bonds to crypto, collectibles, hedge funds, and even why your aunt's safe savings account might secretly be losing money. This is the Financial Avengers lineup. Some are heroes, some are villains, and some are just the guy from accounting pretending to help. Let's start with the safest looking asset class. Cash. Cash and cash equivalents include savings accounts, high-yield savings accounts, money market accounts. Basically, places where your money sits around doing yoga instead of CrossFit. Now look, cash matters. If you lost your job tomorrow, your emergency fund is not supposed to be in crypto coin. But here's the problem. Inflation. In 2022, inflation in the U.S. peaked above 9%. Meanwhile, many savings accounts were paying less than 1%. That's like running on a treadmill while someone steals your wallet. Now recently, high-yield savings accounts started paying around 4 to 5%, which sounds amazing, until you realize inflation still eats a chunk of it. Cash is king during market crashes, and a clown during inflation. Now comes the stocks, the main character syndrome of investing. When people say the market, they usually mean equities. Buying a stock means buying ownership in a company. Apple, Microsoft, Nvidia, Amazon. Tiny slice. Big dreams. Historically, U.S. stocks returned around 10% annually over the long run. And that's why stocks built more wealth than almost any other mainstream asset class. But there's a catch. Stocks are emotionally unstable. It's basically your ex texting, "We need to talk." There are two major ways to invest in stocks: individual stocks and equity funds. Option 1, individual stocks. This is where people become temporary geniuses during bull markets. Picking individual stocks can create insane wealth. If you invested $10,000 in Amazon in 1997, it would have grown into millions today. But for every Amazon, there are thousands of dead companies that disappeared like contestants from reality TV. Remember BlackBerry? Nokia? Peloton? Exactly. Option 2, equity funds. The buffet option. Most investors shouldn't stock pick. Even Warren Buffett said most people should buy index funds. Equity funds are basically a group of individual stocks in the same bucket. Types of equity funds: mutual funds, ETFs, index funds, hedge funds. So basically ETFs and index funds are, I want market returns without having a nervous breakdown option. An S&P 500 index fund gives exposure to America's 500 largest companies. And here's the wild part. The S&P 500 is now heavily concentrated. The top 10 companies account for roughly 35 to 36% of the entire index. Meaning when Nvidia sneezes, majority of the retirement portfolios catch a cold. Then comes hedge funds. They're like Formula One cars. Fast, expensive, complicated, and statistically, most of them underperform simple index funds after fees. Imagine paying someone 2% management fees plus 20% of profits, just to get beaten by a guy buying Vanguard ETFs in sweatpants. Next stop, real estate. Real estate is humanity's favorite investment because unlike crypto, you can actually live inside it. Real estate comes in two forms: property ownership and REITs. Option 1, property ownership. Buy a house, then rent the house. Then pray tenants don't destroy the kitchen. Historically, real estate creates wealth through appreciation, rental income, and leverage. Leverage is the magic trick. You control a $500,000 house with maybe $50,000 cash down. That's why property created so many millionaires. But leverage cuts both ways. In 2008, housing prices crashed, mortgage-backed securities imploded, and suddenly bankers were testifying before court looking like sleep-deprived raccoons. That crisis was the sequel to every saying that housing always goes up. Option 2, real estate investment trust. REITs are basically real estate stocks. You own shares of malls, apartments, warehouses, hospitals. It gives you exposure to property without fixing toilets at 2 a.m. And today, warehouses and data centers are booming because of e-commerce, AI infrastructure, cloud computing. In some ways, AI isn't just a software story. It's a real estate story wearing a hoodie. Next comes fixed income. Bonds are the boring uncle at the family barbecue. But secretly, he owns 3 houses and retired at 52. A bond is basically an IOU. You lend money to governments, corporations, and they pay you interest. Option 1, government bonds. U.S. Treasuries are considered among the safest assets on Earth. Why? Because if the U.S. government defaults, we probably have bigger problems than portfolio allocation. When interest rates rise, bond prices fall. That's why 2022 was historic. The bond market got obliterated. At one point, U.S. stocks crashed, bonds crashed, crypto crashed. Diversification basically said, good luck everybody. Option 2, corporate bonds. Higher risk, higher yield. If a company looks shaky, investors demand higher interest. That's why junk bonds can yield 7 to 10% or more. But remember, high yield is Wall Street's polite way of saying, this might explode. Still, bonds matter, especially when retirees need predictable income instead of roller coaster volatility. Option 3, certificate of deposits. Certificate of deposits lock your money up for a fixed period, like financial jail with interest. A certificate of deposit is basically your bank saying, lend us your money for a while, and we'll pay you more interest than your dusty savings account. The catch? Your cash is locked up for a fixed time. Pull out early, and the bank hits you with a penalty charge faster than a gym cancellation fee. Now we enter the weird side of finance. Alternative investments. This includes commodities, crypto, derivatives, collectibles, currencies, P2P lending. Basically the side quests of investing. Commodities are basically gold, oil, silver, wheat, the real stuff. Gold especially becomes popular when people stop trusting governments. Central banks bought over 1,000 tons of gold in recent years, one of the highest levels in decades. That's not a coincidence. Then comes crypto. Ah yes, the online casino. Crypto created millionaires faster than Silicon Valley, and destroyed them faster too. Bitcoin went from pennies to nearly $69,000, and then crashed over 70%. Then rebounded again. It's basically finance on espresso shots. Collectibles is one of the alternatives. Watches, art, wine, sneakers, baseball cards. Here's the thing nobody tells beginners. The wealthy never go all in, only on one asset type. They diversify because every asset shines in different environments. Example, inflation high, commodities may outperform. Economy booming, stocks fly. Recession fears, bonds rally. Chaos everywhere, cash becomes king temporarily. The goal isn't perfection, it's survival. Because investing is less about getting rich overnight. It's more about staying in the game long enough for compounding to look like magic. So maybe the smartest portfolio is the one that lets you sleep at night while the world loses its mind every election cycle and Federal Reserve meeting. If you enjoyed the video, give a thumbs up, share, and subscribe for more videos. Thank you.